Across today's markets, a tiny starting point can unlock a surprisingly diverse set of assets beyond stocks and bonds. With inflation stubborn, rates shifting, and new platforms lowering cost barriers, $1,000 can seed a broader portfolio built for both growth and resilience. Think of it like planting a garden in a small lot. You mix seeds that thrive in different soils, weather, and seasons. The goal is not to hit a single home run, but to accumulate steady gains and hedge risks over time. If you can start small, you can learn big and compound quietly. The framework today is accessible, pragmatic, and scalable. From a big picture perspective, building an alternative asset portfolio starting with $1,000 means choosing a few frictionless, accessible bets that complement traditional investments. You can place a portion into a broad commodity ETF, a slice of a precious metal custody product, and a small stake in real assets via real estate or infrastructure funds. The trick is using fractional shares, bonds issued by commodity mining firms, and tokenized assets where available to diversify without a big outlay. Over time, you accumulate exposure to commodities, real estate, and energy without needing to own entire barrels, towers, or mines yourself. Small bets scale as knowledge grows. Alternative assets gained traction when investors faced persistently low yields and economic uncertainty. After the 2008 crisis, central banks pushed rates near zero, incentivizing savers to search for value outside traditional stocks. Real assets like timber, farmland, and infrastructure began offering inflation hedges alongside potential cash yields. Technology lowered the barriers through fractional ownership, tokenization, and accessible platforms. By the mid-2010s, institutions shifted modest allocations toward diversified baskets that included commodities, precious metals, real estate investment trusts, and energy exposures. The landscape today blends age-old hard assets with modern liquidity tools, the promise of accessible diversification globally. Today's markets show a slow rebalancing toward real assets as investors seek ballast against inflation and rate risk. Commodity prices have swung with supply disruptions, while equity correlations drift lower in mixed environments, creating opportunities for diversification rather than pure speculation. Banks report rising demand for securitized access to hard assets, and public markets have seen the emergence of new micro-ETFs and tokenized funds that track baskets of resources rather than a single commodity. The net effect is a thin but increasingly meaningful layer of liquidity across alternatives, with some portfolios trimming stock risk and others adding inflation protection levers. Who benefits from accessible alternatives? Large asset managers, pension funds, and sovereign wealth entities gradually diversify toward baskets that include commodities, real estate, and infrastructure. At the same time, retail investors gain via fractional shares and low-cost funds. Companies involved include miners, energy producers, REIT operators, and agricultural firms that monetize real assets. Indirect beneficiaries include fintech platforms that lower entry barriers and custodians who provide secure custody. The net effect is a wider audience of savers able to participate in inflation hedges, while managers reallocate portfolios away from single market bets toward diversified risk premia. This shift changes advisory dynamics. Macro and geopolitics set the stage for why alternatives matter. inflation remains stubborn in many regions, while energy supply constraints and trade tensions keep volatility elevated. A weaker dollar can lift commodity prices and narrow the appeal of conventional bonds, nudging investors toward hard assets. Climate policy, land rights, and infrastructure booms shape where money goes, with governments seeking resilience through strategic reserves and long-term projects. In emerging markets, currency risk and inflation spikes test shoppers and savers alike. The overall climate is a patchwork of growth cycles that makes diversification not optional, but essential for risk management today. Smart money is moving slowly but decisively toward diversified real asset sleeves. Institutional allocators blend private and public markets, using funds that target inflation hedges and risk premia, rather than simply chasing equity beta. Endowments and pension funds often favor timberland, farmland, and infrastructure through co-invest programs, while family offices experiment with tokenized funds and crypto-linked commodities for liquidity. Retail investors mimic these moves by buying fractional access to precious metals, energy, and property via ETFs and crowdfunding platforms. The net signal is cautious optimism. Build exposure gradually, monitor fees, and avoid chasing crowded trades. Patience and discipline win. Bear case and risks remind us that this is not a free lunch. Illiquidity can trap capital in real estate, timberland, or private funds for years, with redemption cycles unclear and fees high. Valuations for tokenized assets or niche funds can swing wildly as hype grows or fades. Tax complications, custodian risk, and counterparty exposure add friction. Regulatory changes could tighten access or raise compliance costs. In addition, correlation falters in crisis, and crowded trades can amplify losses. The prudent approach keeps a clear plan, a conservative allocation, and exit rules that trigger when fundamentals deteriorate or costs rise meaningfully. Retail investors can respond with a clear plan and disciplined execution. Start by defining a simple target allocation consistent with risk tolerance. For example, a 60-25-15 split across equities, real assets, and cash equivalents. Then pick low-cost doors into alternatives, a broad commodity ETF to capture energy and metals, a precious metal exposure through a trusted custodian, and a diversified REIT or timberland fund to gain real asset exposure. Use fractional shares and auto investment plans to build gradually. Avoid chasing trends, watch fees, and rebalance quarterly. Keep emergency cash uninvested and test the plan with small, real-life wins and losses. Looking forward, the case for $1,000 start is not a dream of doubling money, but a disciplined path toward resilience, education, and compounding. As platforms improve, costs fall, and regulatory clarity grows, more investors can mix hard assets with traditional holdings to weather shocks. The real opportunity is education, automation, and habit formation. Automate contributions, track performance, and cut losses early. The mindset shift matters as much as the assets themselves. Consistency beats speculation. Measure progress with simple metrics and keep fees in check. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.